In this video, Trader is going to answer a question from a subscriber, which is what about using capital reserves when trading? Stay tuned. Hey guys, well, welcome to you. Right, so question from a subscriber, a viewer of the channel, much appreciated. Thank you for taking the time to write in, as I appreciate all your comments and questions and support, guys. I get some of the questions sent through, and if I can do a video on it to help you, then I will. If it's a quick reply that can be done and can be sent out, then that's the way it will be as well. But I appreciate all your comments, questions, support, likes, shares, all that other good stuff. Right, so this was Pantera Razork. He says, or Panthera Razork, I'm pronouncing your name wrong. If I have, I do apologize. Quick question. What about capital reserve when trading, while trading? While I use only 2% of my capital for trading, I do tend to open quite a number of positions. Think about 75% of the entire capital. When I'm aware this is pretty risky, I keep getting the feeling that if I don't use the capital, I'm not using its entire potential. Any advices in this regard? Thanks. Right, appreciate your question. What a great question. You guys asked some good questions. Hopefully this might help a little bit of my viewpoint on it. And also, if you guys got any comments, then please add them, because this is a community, guys. We're trying to help each other out here. So what I might say might not be right. Someone else might have a great bit of nugget advice. So stick it in the comment section below. Okay, so the idea with trading capital is this, is that fortunately we can trade with leverage, right? So that means we've got money in there and we can use it as deposit to trade more capital. We understand the kind of double-edged sword with margin and leverage. So it gives us the opportunity to have, like in that example, multiple positions or have a bigger, larger position. The problem we've got is that we end up thinking that we need to be using every single cent. And I appreciate where we come from. We're like, well, it's there's the opportunity, why don't I use it? The two problems you've got issues with that is that one, you end up trading stuff that you don't really want to trade. Like in that example, possibly if you've got positions, are you just trading them because you want to utilize all your capital? In which case you might be vulnerable because you're taking C and D grade setups, which aren't really going to help you in the longer run. And in fact, they might even do damage. Whereas if you're trading a small portion of your capital and you're trading those A grade setups, yes, they may be less frequent, but what about if you allocated more size to those? What about if you spread the risk like that? And that actually brings me on to the question of size, is that you actually end up thinking, well, I can trade in this size, why don't I do it? And there's a story for you guys. Probably 10 years ago, around that sort of time, maybe a little bit, yeah, about 10 years ago, I was having a real problem with trading too much size. I would, and this was before ESMA, way before ESMA, I knew you had big leverage, you could trade big size. I went through a phase where I was trading big size and it was really going great. And then the market conditions changed and I backed off the throttle a bit. But I'd always be wanting to push more size on because I was be looking back to those months and thinking, I want those months again, I want those months again, I want those amazing months again. But the conditions would change, the conditions had changed, and it was probably only a second time this kind of cycle had happened to me in terms of conditions had changed. And so I was still trading it, but I was trading at smaller size, but I kept wanting to go more and more and more. And when I ended up pushing my chips in and going bigger, of course I'd be getting stopped out because this wasn't conducive to the right environment, unlike the prior 2 quarters ago, whatever it was. And so what I did, a great way of doing it, is I pulled out all of my capital except for this. I had my margin requirements for the size of my trades. So I worked out the exact size I wanted to trade in the instrument, and I worked out how much margin I'd need for that, and I worked out how many trades I'd have simultaneously. For me, it was always only going to be one trade because I was very focused on one instrument. For you, could be a selection of trades. So you work out the margin requirement, and then you work out the maximum drawdown you're going to take in, let's say, a week's period. So worst case scenario, you're going to lose, I don't know, let's say for argument's sake, you're going to lose £1,000, right? So let's say for argument's sake, you're going to risk £1,000 in the week. And let's say your margin requirement is £5,000, okay? That means you need in your account that plus the £1,000. And also you've got to allow for the margin if it's going against you, But if you're day trading, this is like a loss. So you might need a little bit more to allow for that, because you might need this more to allow to hold the position. Because obviously if you've got £1,000 and it goes down to 4,000, you're not going to hold the same position. So you're going to need 6,000 plus another 1,000 on top of it to allow for the loss. And then you take the rest of the money out. So that stops you from trading overtrading, or stopped me from overtrading because I just couldn't overtrade. I didn't have the margin requirement. If I wanted to overtrade, it would just come back and got the margin, mate. Deal with it. And so that was like a forced way of doing it. Slightly off topic, but the point is you can use the leverage requirement to your benefit. You can use it to your advantage and say, well, I don't have to use it just because you've got a 50 grand, 100 grand, 200 grand, 800 grand account. Doesn't necessarily mean you have to have it all in the account and be using it. You can still have it allocated as risk capital, but only have a smaller amount actually in use because you don't need it because you're using leverage and margin. So there's a couple of ways of looking at it. That capital can be sitting there to perhaps replenish. If you end up having a down quarter, you're like, well, I'm still in the game, but I'm just going to have to shift money back in, or you pull money back out. So you don't have to put all your money into the trading account and use all of it, because even though it's so tempting to do, what do you do then if the margin requirement is suddenly reduced? Do you end up using more? Or maybe if it's increased, like ESMA recently, so everything's increased, does that end up really impacting you because you can't trade less? I think that you're looking at capital as a tool, but allowing it around your existing strategy rather than having that rule your strategy. So if your strategy is to trade a basket of shares in your portfolio, a basket of positions, then stick to those positions. And if you've got a surplus sitting there, then by all means, that's the case, that's the way it is. No trade is a trade. No position is a position, as is not using all your capital is also not using your capital. And don't forget the opportunity cost. If you're all in on everything, and you're using all your allocation of capital, then when there's a really good opportunity and you really want to kind of press the throttle on something you've seen, you've got to make another decision of getting rid of some things to free up capital. So you're constantly jobbing things around. Maybe that trade hasn't matured yet. You're constantly kind of trying to shuffle money and paying commissions and spreads, and you're over the price. Whereas if you've always got that money there sitting there, you've got your positions on, and another position comes up that you like that's within your parameters, you allocate capital to that. You can allocate capital to that. You've always got firepower ready, and you're not kind of fully loaded all the time. So that's just my opinion on it. Some people's opinion might be different. I think you just use a chunk of it for what you need, and the rest of it may be risk capital if you like, but it doesn't have to be in your account as such. It can be elsewhere, or it can still be in your account. You don't have to use all of it. Maybe some people are different their opinion. I'd be interested in your guys' opinion on it, because for me, I guess as well, I'm normally only trading one, maybe two positions at a time, very focused on those. Sometimes it might have things that are holding for longer term, but I know a lot of you traders out there have more positions that are more larger positions holding for longer, and so the capital allocation becomes a little bit different as opposed to the kind of shorter term things where you're allocating a lot of capital, pulling out, a lot of capital, pulling out, etc., whereas you kind of broad and things are coming in and out of the portfolio. So yeah, be interested to hear your guys' comments in the comment section below. Appreciate the question, as I do all the questions, guys. Take care. See you next one. Get your risk managed. Bye bye.